Good morning, good afternoon, good evening. A very warm welcome to the third and final day of the International Conference on Disaster Resilient Infrastructure 2021. This is the last and final day, and it promises to be a very exciting, very engaging day where we will delve deeper into some of the issues, particularly related to finance, recovery and reconstruction, governance and policy. But before we begin the day, let me recap what we did yesterday, the second day of the conference. The second day of the conference was a rather packed day for those of us who were in Delhi. It was a 12-hour day, bookended by a session in the morning, which was focused, it was a regional forum focused on the Pacific Islands, a session in the evening, a regional forum focused on the Caribbean islands. And in between, we had three very important sessions where we looked at how we can make use of emerging technologies and innovation for enhancing disaster resilient infrastructure. What can we do to enhance the resilience of digital infrastructure? And finally, we looked at urban infrastructure resilience issues. It was a very interesting day. The two regional forums focused on SIDS really brought alive the whole challenges that the small island developing states face. One quote was that we should no longer refer to these geographies as small island developing states. We should call them big ocean states. In addition to that, we also had fairly deep analysis of some of the challenges that the SIDS are facing, but also some of the innovative work they are doing, some of the planning, forward thinking that they are doing to meet those challenges. And in a lighter vein, we had cricketing analogies. We are here in India, and when we spoke to the Caribbean, we had cricketing analogies on, what kind of pace attack do we need to meet or to win the resilience match. I mean, that's a conversation that has to be continued with the Caribbean, both on and off the field. With that, now we are all poised for the final day. Before we start the final day, I just wanted to highlight one particular issue which is permeated throughout the conference. Our Prime Minister, Honorable Prime Minister of India, spoke about the need for predictable finance. The Prime Minister from Fiji made a passionate plea for how SIDS require financial support. There was very clear articulation from COP26 President Dr. John Merton talking about adaptation and what success would look like in COP26. He identified three pillars. One was planning, the second was action, and the third was finance. And he said that these three pillars all are required. So emphasis on finance. Administrator of UNDP on the policy forum on the first day talked about a predictable finance, but the right kind of finance which nudges us towards resilience rather than risk. So this has been a conversation. It has also emanated from the private sector. Mr. John Haley, the CEO of Willis Tower Watson and chairman of the Coalition for Climate Resilient Investment. So this is a conversation which is, this is a thread which is permeated across all the sessions, and that's why the third day, first session, is focused on finance. And when we talk about finance, it's not just the quantum of finance, but also the quality of finance, how finance is structured, what is the kind of policy regulatory environment, what is the kind of data analytics, risk analytics that informs finance so that we can move towards investing in a way that we take into account risk-adjusted returns and not carry on the business as usual. For that, we have an exciting session which we have planned with our key collaborators in this endeavor, the Coalition for Climate Resilient Investments. The session will be moderated by my longtime friend and colleague, Carlos Sanchez. He's the Executive Director of ICDRI. And we've brought together a very interesting cast of colleagues who are working on different aspects of finance, from pension funds to people in the government, to people who are into asset management, to bilateral development partners. With that, before I turn over to Carlos Sanchez, let's watch a video to have some framing of the issues on financing for disaster resilient infrastructure.
Critical infrastructures such as transport, power, telecommunication and water play a critical role in sustaining and advancing human and economic activities, maintaining our quality of life and protecting livelihoods. Unreliable infrastructure networks pose serious risks to social and economic continuity globally. Climate change and natural hazards increase the vulnerability of assets to levels never seen before. Recent catastrophic events have highlighted that economic losses experienced in the critical infrastructure sectors like power, transport and telecommunication alone can be more than 60% of total economic losses. And because of the interconnected nature of infrastructure systems, indirect losses due to disasters could be up to 20 times more than direct losses that could even result in adverse impact for the economy as well. Recent research has shown that $1 invested in resilience could save $4 in post-disaster scenarios. And it would only cost a mere 3% more than the overall investment to increase the resilience of infrastructure. However, the world already faces a significant shortage of traditional investment in infrastructure. Current calculations project a shortfall of $15 trillion in the estimated $94 trillion of worldwide infrastructure demand by 2040. Post-COVID-19, this gap is likely to be even wider. Governments alone cannot cater to these demands, which make the support from the private sector crucial. While there is an estimated $106 trillion of private institutional capital available worldwide, only 1.6% of it is invested in infrastructure. This makes shifting focus to the financing of resilient infrastructure an even more urgent task. The private sector can and must play a pivotal role in addressing this gap and improving climate and disaster resiliency. For this, we need to have greater cooperation between the public and private sectors to finance resilient infrastructure through public-private partnerships. ICDRI is working with other development partners to enable innovative policy developments that could create avenues for greater public-private partnerships in financing resilient infrastructure.
Fantastic. And Kamal, colleagues, audience, sincere thanks for your time today, for the invitation. A true honor to be here with you in this last day of the International Conference for Disaster Resilient Infrastructure. A personal thanks to Kamal for an incredible partnership since our joint launch at the UN Climate Action Summit back in 2019. Where CCRI and CDRI were jointly launched, and also to congratulate the Coalition for Disaster Resilient Infrastructure for the incredible momentum, progress, and substance that is being generated over this time. I also want to thank the audience for making the time on what is a Friday afternoon in India to be here with us and to share the very interesting discussion that is just going to happen. Last but not least, thanks to the incredible star panelists that we have assembled today from both the private and the public sectors to have a very important discussion. And it's a very important discussion about what we just saw on this great video. And it's about what are the challenges in mobilizing private capital and to make that private capital complement public capital for the purpose of investing in resilient infrastructure. And the question is, why, if the figures that we just saw in the video are so clear and the research is so strong, why the flow and allocation of capital to resilient infrastructure is not matching that need? And this panel is going to explore what are the reasons for that. Kamal very nicely framed the consideration about incentives for private capital to flow into a given type of investment, either region or asset class. Those incentives need to be in place. And I believe that this conversation is going to be a great opportunity to really dwell into how those incentives are in place and are ready to really nurture those investments in resilient infrastructure. My name is Carlos Sanchez. As Kamal said, I'm the Executive Director of the Coalition for Climate Resilient Investment. As also Kamal said, partner a sister initiative with CDRI. Our focus is more on the practical solutions for that mobilization of private capital for resilient investment. So very much focused on the cash flow modeling component to that, financial innovation, new instruments that really facilitate that allocation of capital, and also working with governments to allow them to have a better understanding of where the hotspots of economic and social value are in their given jurisdiction, in a given time horizon. And I think that is one key consideration to really illustrate and to really go to the conversation to understand how different incentives and the drivers for action are for public and for private. What the materiality assessment differs from that public governments and private investors, whereas for public governments, it is about protecting economic, social, and ecosystem value. For private investors, though those economic, social, and ecosystem value are critical and important, the very central consideration, core consideration for the decision-making is risk-adjusted returns. There is an opportunity, and it's an opportunity that thanks to initiatives like CDRI, we have at reach to really make those incentives speak to each other and to really advance the necessary capital to protect economic, social, ecosystem value while we protect and enhance risk-adjusted return. So let me give the floor and start introducing the fantastic cast of panelists that we have. And I think that from there, it will be them that will guide us through this fascinating discussion. So let me introduce them. And then from there, I'm going to pose the first question, please. So first, very, very thankful, Mr. Pankaj Jain, Additional Secretary, Department of Financial Services, Minister of Finance, Government of India. Thank you for being with us today, Mr. Pankaj. We will hand over to you in just a little bit. Mr. Abhishek Podar, Managing Director, Macquarie Infrastructure and Real Asset, otherwise called MIRA. Abhishek, thank you very much for being with us today. Again, we will give you the floor in just a little bit. Ms. Rachel Turner, Director of International Finance and the Foreign and Commonwealth Development Office, the UK government. Rachel, thank you so much for being with us today. Mr. Michael Ridley, Senior Responsible Investment Specialist at HSBC. Also, Michael, thank you very much for being with us. Last but not least, Ms. Kelly Christodoulou, Senior ESG and Stewardship Manager at Australian Super. Kelly, thank you so very much also for being here. And Kelly, if I may, I'm going to start with you, the run of questions. Before doing that, just a reminder to the audience that we will go through a first round of questions. From there, we will try to reflect and open a discussion between panelists. And in the meantime, please pose your questions that we will collect, and I will share with the panelists in a final round that we hope to be able to cover at least 3 of your questions, audience. So with that, let's have a start. Kelly, let me ask you the following. So Australian Super is a recognized leader in the climate risk space. In the area of resilience, rightfully so, the discussion is focused on the importance of protecting lives, economies, and ecosystems from physical climate risk. However, as just discussed, for institutional investor, it's also important to frame this discussion around the protection and enhancement of risk-adjusted returns. How mature do you think this discussion is? And what are the main challenges to fully advance it and to see that those flows of capital really being focused in resilient infrastructure? Kelly, the floor is yours. Thank you.
Great. Thank you very much, Carlos. A bit of background first. Australian Super is one of the larger pension funds in Australia with over 200 billion Aussie funds under management. Roughly 12% of that 200 billion is invested in infrastructure. We have been investing in infrastructure since the 1990s, and indeed we still hold some of those assets. As a country, though, Australia is exposed to extreme weather events. we have already experienced extreme climate occurrences ranging from bushfires to flooding, which has impacted our infrastructure assets. In the area of resilience, we began our journey back in 2011 when we assessed 4 of our larger Australian assets for physical climate risk. The findings found that the climate resilience of the asset very much depends on the age, the type, and the location of the infrastructure asset. Since then, though, we have evolved our process so that physical climate risk and resilience is now part of our due diligence process. So now, when we look at new infrastructure assets or new deals that come through, we include a physical climate review of that specific asset. But when we are owners of these assets, we generally are long-term owners, so decade-long owners. And because of this, we have to become active owners. We work with the asset, the management of the assets, to improve its overall ESG credentials, including improving the resilience to climate change. So Carlos, coming back to your main question, I think the main challenges are, or is, the lack of an appropriate investment model to internalize the climate change physical risk. And second to that is standards and regulations. So this is why we, as Australian Super, support the Coalition of Climate Resilient Investments, or the CCRI, because we want to better integrate physical climate risks into our investment decision making. Thank you, Carlos.
That is great, Kelly, and sincere thanks for the public support to CCRI, which means a lot to us. On the substance, incredibly valuable what you share in terms of the integration and what are the let's call it the shades of gray in that integration, and how despite Australian Super being at the forefront of that, there's a perception that is still so more to be done, but there is already a lot that is being integrated into that. And particularly valuable coming from Australian Super, that apart from playing a very, let's say, powerful role in the investment value chain on how capital is allocated to asset managers and down that chain, also you have that perspective of an active investor. So that, I think that provides you with a particular valuable position in this space. So thank you very much, Kelly. If I may, I will go now to Michael Ridley from HSBC. And Michael, the question is the following. So you, HSBC, and together with a number of key institutions and relevant stakeholders, are advancing Fast Infra, an initiative focused on sustainable infrastructure and related standards and financial solutions. Could you share, Michael, with us, what do you think the role and importance of resilience is within this work of Fast Infra? And the overall taxonomy of sustainable infrastructure, how does that weigh against transition risk, about other considerations that may be in that important taxonomy of sustainable infrastructure? And also, could you share also what do you think are the chances for resilient infrastructure to become an asset class in itself, or should it be the asset class sustainable infrastructure? Michael, the floor is. Thank you.
Thank you so much, Carlos, and I really appreciate the opportunity to be here. So absolutely right, yeah. So HSBC, along with the OECD, the IFC, CPI, and GIF, created a group called Fast Infra Finance to accelerate sustainable transition in infrastructure. And then after 2 global calls of May of last year, we broadened it, and membership is now about 80 institutions, banks, asset managers, governments, MDBs, NGOs, etc., etc. We're pursuing 5 key ideas, but the one that's most pertinent perhaps to this conversation is around a label for sustainable infrastructure. We got the sense that if we could create a label that people wanted to have and say their asset was sustainable according to the Fast Infra label, that would get conversations at the pre-construction phase of host governments and developers around issues of environmental strength, environmental quality and resiliency. And also the label could play an intertemporal role post-construction. It could offer cover for asset managers who want to create sustainable infrastructure debt funds to say, we are going to refinance this asset. The Fast Infra label says it's sustainable. That's good enough for us. So we've done quite a lot of work in a very broad public-private partnership approach here. You mentioned the word taxonomy. We took a sort of view right at the beginning that our approach should be fairly private sector focused, although we are working very heavily with governments and MDBs, of course. And we wanted to sort of pitch it so that the standards underpinning the label are not overly complex. So we put it in the middle. We sort of have high level principles on one side and then detailed taxonomy, 800 pages and plus. Ours is sort of in the middle, a 6-pager that's going to help developers when they go forwards to try and develop sustainable infrastructure. So quickly on resiliency, with our work, there are 15 criteria under 4 dimensions. And the 4 dimensions are environmental, social, governance, and resiliency. And I think we took the view there is if you want your asset to be sustainable, you don't want it to, have a lot of emissions and lock the world into a high emissions trajectory. But equally, you want it to be resilient to climate change and natural disasters going forward. So that the R kind of came naturally with the ESG, although I think your institution was very heavily involved sensibly in discussing resiliency at early stage. So we think the resiliency is a key part of the story. In terms of the second question, can it become an asset class? There's sort of been 2 debates. One is, can we make infrastructure an asset class? And then the other is, can we make infrastructure sustainable? And we're trying to combine the 2 and can we make sustainable infrastructure an asset class? And we think the label is a helpful first step. You might say, okay, there are other raters of infrastructure out there, GRESB, Global Infrastructure Basel, et cetera, et cetera. Well, happily, we've already been working with them, particularly the Global Infrastructure Facility based in DC has already over the last 3 years been working with them to sort of reduce and come to a clear set of standards. And we're using that work to develop the 15 criteria. So I should say that the label work will go to a series of roundtables starting in April, and then a public consultation in May. So we'd be delighted to, if people call us today, got involved in the consultation around the label, we'd be delighted for that. Hopefully that's helpful as an intro, Carlos.
Incredibly helpful, Michael, and really powerful. That body of work in articulating sustainable infrastructure towards those lenses of project structuring and really responding to the needs of investors and aligning those with certain standards from multilateral development banks, which is, needless to say, the most critical discussion and relationship when it comes to mobilizing capital to non-OECD jurisdictions. And also incredibly interesting your positioning of sustainability vis-a-vis resilience, and totally agree, of course, that resilience is a component of sustainability. So there's no real sustainability without resilience, but resilience as standalone does not necessarily become sustainable. And that is why we at ICDRI, for example, we have the focus that resilience understood as pricing physical climate risk is such a misprice or failed side of that taxonomy that we want to work first on that, but certainly the way forward is to integrate that with other considerations, both in terms of other climate risks, but also in terms of other themes within the sustainability denomination. So thank you so much for sharing your thoughts, Michael, and the great work of Fast Infra with us. Can I go next to Rachel, please? And Rachel, the question in your case is ensuring that resilient finance reaches most vulnerable communities constitutes a formidable challenge when we discuss resilience at a systemic and at asset level. So both at the national, but also at the unit individual level. From your perspective and experience, is it possible to align the incentives of capital to deliver risk-adjusted returns, but also for that same capital at the same time to protect economic, social, and ecosystem value from most vulnerable communities? And if so, what are your main recommendations to either maintain it, but most critically to also to advance it? Rachel, thank you very much. The floor is yours.
Thank you very much, Carlos. And I guess, the first thing I would say is that our objectives together have to be that we're delivering resilient infrastructure that reaches the poorest. I think as COP president in this COP year, we're absolutely clear in the UK that success for this body of work has to be measured by the fact that we're improving access to resilient infrastructure for the poorest. On your specific question, I guess I would say a couple of things, Carlos. I mean, I think the first is the fact that the poorest communities are actually an extraordinary asset in understanding risk. It's often the poorest who are most vulnerable to risk, but then also understand it well. And I think one of the challenges that we have as an ecosystem in working on resilient infrastructure is how we can work to harness the value of local community understanding of risk. I think we do feel that if we can begin to get that right and feed that understanding through into the risk modeling, then we begin to build that, if you like, that kind of virtuous circle of forecasting and understanding risk that feeds through then into design and into capital pricing, and in turn lowering risk, because I think fundamentally understanding risk is what can help us lower risk. And I think it's always worth reminding ourselves that we have very, very poor consumers as the end clients for much of this infrastructure. And if we don't understand the impact of shocks on their ability to engage with the infrastructure service, we'll be missing a stage of the journey. So that's absolutely part of what we need to do. But I do think we can be quite confident that we can do this. And there's some really good work out there, actually. And one of the things that I've been following particularly is the work we've been doing with ICDRI on the systemic risk assessment in Jamaica, where we've been looking at climate risk in key sectors, transport, water, energy, and then actually looking at how interventions can be prioritized, particularly looking at both retrofitting, but also new investments. And I think it's really important in this discussion about how we can get the right balance between the capital risk return and the impact on the poorest is actually how we're choosing which infrastructure to invest in. And that prioritization piece is also a really important part of the story. And I think that Jamaica work is really interesting in that strand. I think the final thing I wanted to say is just the interplay with development insurance and risk coverage as one of the key parts of the ecosystem here for managing this balance. And I think, Carlos, that we've been closely involved with advocating for and supporting the development of what is now increasingly being called development insurance based around the risk pools. But I think what we're seeing there actually is that it is possible to begin to create a virtuous circle whereby, as we start to understand the effect of risk on the very poorest and how they access services, we can also begin to then feed that through into how we design risk coverage and how we can get very effective automatic response when there are risk events. And I think that automatic response to risk events underpinned by development insurance can also play a very strong kind of underpinning role in how we begin to build sort of overall confidence in the risk equation. So, Carlos, I think those were the main things I wanted to say. Thank you.
Rachel, incredibly valuable, and I'm going to struggle to unpack because there is so much and diverse in that you touched that is so important to reflect on. And so thank you for sharing with us. So I think that you made a reference, first of all, to data and the role of data in both explaining but also in solving this situation. And I could not and we could not agree more in what we are saying. What Kelly was saying earlier about the integration into effective investment decision making, the role of data is critical to see how in certain time horizons, years 0, 5, 10, 15, and 20, we have a good physics story as of a probability of an event of a certain magnitude in a given location. So that is incredibly important to bring light to. Second, you also bring light to the, let's say, the perverse incentive that maybe, or what we in CCRI call the risk of pricing risk, that is that those most vulnerable regions and geographies, if we focus only on highlighting the risk level, it may be that we see capital flight. And that is absolutely the last thing we want to see here. And we need to ensure that capital will go to most vulnerable jurisdictions in that regard. So there is a critical component in that regard. And thank you for bringing light to that, because we need to be laser focused on really making sure that investment is reaching to where it's most needed. And then big thanks for the mention again of CCRI, and an even bigger thanks for the support of FCDO to CDRI from day zero. We couldn't be where we are without your support. And particularly the case in Jamaica, I have to agree that it's a very interesting case where we see the matching of the economic case from a government that says we are concerned, we need to know where to allocate our limited fiscal budget into the projects that will protect the most economic and social value. So where $1 is going to protect the most economic, social, and ecosystem value? That is the exam question for which we, as of today, we don't have a perfect answer as a methodology. So we are trying in a humble way, in collaboration with institutions, to really advance that discussion. And then in combination to that, then there is the more private finance solutions that Kelly brought light to, that are going to work in making sure that each individual of those investments prioritized are happening at the right level. So your resilience is not a binary discussion as of an investment happening or not happening. It also needs to happen in the right attributes for it to deliver to society, but also to deliver to the investor. So I think that in that regard, thank you for bringing light to that, because that is where we spent a lot of time in that matching, and where also working with CDRI has been really, really enlightening in advancing the thinking. And that systemic areas where also CDRI in their analytics side of the work plan, they have an incredibly interesting piece of work where we want to contribute with. So Rachel, a big thanks on all those counts. Let me then move to the next panelist. Abhishek, if I may go to you, the question is the following. Macquarie, as all investors here, is laser focused on investable attractive. What makes a resilient project an investable one? Also, in terms of aggregation of resilient projects, where are the key challenges in building a resilient infrastructure portfolio? Abhishek, the floor is yours. Thank you.
Thanks for that, Carlos. And first and foremost, my compliments to CDRI in organizing this fabulous conference and getting all of us together on a topic which is extremely pertinent. And to give everyone a sense, Macquarie or MIRA, what I represent, we are the world's largest infrastructure investors with over $100 billion of equity that we invested in infrastructure assets across the globe. Managing more than 150 portfolio companies that impact 100 million people on a daily basis, right? So for us, as investor, it's not just about returns on the asset and investments that we make, but also the impact it has on the community that we live in, on the people that we employ, on the broader stakeholder itself, because that becomes a very big part and component of this entire investment thesis. And from that perspective, whenever we've been looking at investments, I guess the entire topic of resilience has become extremely, extremely important. And I'll share a couple of points here. Obviously, Carlos, I think when you were introducing the topic, you said for investors like us, risk-adjusted return is paramount important, and that is absolutely true. What has started to very clearly happen is over last decade and a half, I must say, the risk that is getting associated with resilience or the lack of resilience or disasters, that has started to go up. And hence, for players like us, when we look at new investments as well as what we play with the existing investments, there is a very clear focus on the resilience itself. We have started to incorporate clear long-term forecasting depending on the asset class. If it's a transportation asset, let's say the risk of flooding, the risk of earthquakes that can happen, right? If it's in a slightly more earthquake-prone areas, what are the risks that are emanating to this? Those assessments have started to become an integral part of any new investment decision that we make. And there have been cases where we've actually walked away from investments because we just couldn't justify the underlying risk that an asset class could present and the returns that were coming in. So it's a real problem and started to impact the behavior of investors like us. At the same time, even the assets that we own, we have been investing quite consistently now in improving the resilience of those assets themselves. And I can share a few examples. For example, we own a very large solar portfolio in India. And when we did the assessment, we did the entire risk assessment, flooding, earthquake, etc. But our experience was, and we've been holding this asset for about 4 years, in a part of the country where over the last 4 years, the amount of rainfall that we've seen has been 20% above the 20-year average that part of the country has seen. And that has resulted in flooding of some of our assets. Now, that was never a part of plan, right? And hence, the amount of, that made us sort of go back and look into a more blueprint review of the entire investments that we've done in different solar farms, and then undertake, specific flood resilience programs, for example, right? Similarly, we have an investment in world's largest geothermal asset in Philippines. And Philippines, as many of you know, is very prone to earthquake situation, right? So there's been a lot of investments and assessment that we've been doing out there to ensure business continuity, even if there are heavy earthquake events that can happen. Right? Similarly, we own a very large utility in Australia where bushfires has been a big issue for us, and we've been using now technology, LiDAR, and various other sensor schemes to see our vegetations coming into the picture, and hence the risk of bushfires and other natural events happening, right? So this entire aspect of thinking about resilience at the time of investments, and not just stopping there, but continuing strengthening the assets, even when you hold, is an important part of the entire financing and investing approach that investors like us have been taking. And I believe this is possibly the only way when you look into the infrastructure asset class. I think as Kelly mentioned right at the beginning, when you look at infra investments, you look at not from a 2, 3, 4, 5 year perspective, you look at from a 10, 15, 20 year perspective. And the intensity with which the climate changes are happening, and that's impacting the business on the ground, there's no other option but to ensure that you build that resilience so that irrespective of 5 years down the line, whether I'm the asset owner or somebody else is, the underlying asset performance continues to be there. So it's a very simple business economics which is driving business behavior of all of us. I think final thing which I would like to leave is on the point, Carlos, that you talked about data. Unfortunately, that is the biggest challenge that I see today when it comes to resilience management. We can do all 20, 30, 40, 50 year trailing assessment, but what we're seeing in the world and right now is 50-year averages don't work, because last 20 years is very different from 50 years. The next 20 years will be very, very different from last 20 years, right? And hence the extensive use of real-time data, more data inputs, as well as technology and digital will go a very long way in terms of identifying the risk and then undertaking resilience improvement interventions across the assets. Yeah, so those were some of the thoughts that I had on this particular point.
Well, those are not just some thoughts. That is so incredibly rich thoughts that you share with us, Abhishek. Thank you so much. And again, as with previous panelists, challenging to unpack just because how rich those are. So let me attempt to do that, Abhishek. And I think that data, of course, and you speak about, to some extent, how simple the economics are, but also, in a way, you're saying how complex it is, because you need to be able to interrogate every year's cash flow of the duration of that asset, how climate risk will affect, not just in terms of loss and damage, but in terms of revenue, capex, opex, depreciation, cost of capital. So that's why infrastructure is the place to start. First, because it protects economic and social value in any country, but second, because we can illustrate or make a proof of concept of integrating physical climate risk in investment decision making. I think that you also make a very interesting point about, let's say, the spreadsheet versus reality, and the projected cash flow model versus the realized year by year, experience of cash flow. And that, I think that is the extremely valuable point, where if I interpret correctly, and you please, I will allow you to say otherwise, but in a way, what you're saying is, to some extent, there is a tension between bankability and resilience. If you integrate resilience on an ex-ante level on that spreadsheet, and you conclude that you're not going to need 100 capex, you're going to need 102, in exchange of that, there is not a full recognition in terms of, let's say, cost of capital or more enhanced cash flows. Therefore, what you will need to do is to take a risk beyond the risk-adjusted return risk on on banking on that realized return being higher than the spreadsheet and the cost of capital tells you, which brings us to evaluation risk consideration around physical climate risk. So, and I think that as yourself, and a big thanks also to you in support of CCRI, that is what also is mobilizing institutional investors, that they recognize that there is an incredible social, economic, and ecosystem component to this proposition, but then there is a valuation risk, that we see how regulation is advancing in a very promising way, rating agencies too, analytics too. So we see a point in the future where at the systemic and at the asset level, we are going to be able to better integrate that. So advanced actors like all here have an interest to position themselves in that regard. Abhishek, if there is anything that you want to correct me in that interpretation, please feel free to come in again.
No, absolutely, Carlos. I think you know the topic as well. So very well said. One can speak about this topic in so much, but I think you captured the gist of it very well. Thank you.
Thank you so much, Abhishek. So if I may go now to Mr. Jain, the question is the following. The government of India is showing real leadership in the resilient infrastructure space, of which CDRI is the best illustration. From that perspective, where do you see the role of governments in advancing real incentives for private capital to support investments in this space? Prakash, the floor is yours. Thank you very much.
Thank you, Carlos, and it's been quite interesting listening to some of the other views. So yes, I think recognition at the highest levels of Government of India on the impact of disasters and what it can actually mean for projects, for livelihoods, for quality of life, I think it's right up there. I think what is going to probably take a little longer is for it to percolate down to a project level, to financing models, to technical design. And that, I think we must clearly recognize, is work in progress, because I think more than national perspectives, financial incentives are really going to drive that decision. So having said that, what is it that can be done at a systemic level? Or what is it that can be led by government in terms of changing that? And let me just highlight 4 key points there. There are many more, but let me limit myself to 4. First, obviously, is awareness. Now, what is this about awareness that I'm talking about? It's not just events like this, but to talk to project developers and proponents to say that, look, a disaster is not simply a black swan event, not any longer. I think in a perverse way, a disaster last month, an avalanche last month in the Himalayas meant that 4 hydro projects just disappeared. So it suddenly brings home to you the reality that disasters can happen with increasing frequency and with much more ferocious impact than in the past. And therefore, to also understand that thinking about disaster while planning a project is not to reduce it to a go or a no-go decision. There are costs involved, but perhaps a cost may be worth it if by doing certain things, my project could become more attractive to financing or to investors. So there is a story to be told there. The next point would be, I think change in specs at a national level matters. So for instance, we have seen this, changes in building bylaws so that a building in a zone 5 seismic zone had to meet certain higher standards versus a building in a seismic zone 4. That itself became a given. So you had to everybody had to factor that in. Third is a funding window, obviously, which could be to some extent government supported. It could be analogous to green funding. And again, we have an illustration. I think, let me take an Indian example. We have a lot of power plants which run on coal. Now, coal is a polluting fuel, but a certain incentive was given for, it partly came out of court orders, partly out of government's intervention, for what are called FGDs, or flue gas desulfurization, which came in thermal plants. That is something which again helped in terms of making the case as to why this needs to be done. And finally, I think the fourth point would really be that capital structuring in an era of disaster risk mitigation has to be married, at least for some projects or some type of projects, with insurance products. Because we will not be able to actually make sure that every kind of contingency is taken care of. And I think the point which Kelly made about age, type, and location of assets will matter in terms of configuring these solutions. So let me stop there, and I think I'll be happy to take questions on this.
Pankaj, another very, very valuable contribution to the discussion. Thank you so much. I'm going to focus the reflection on what you just said in two key components. First is, because I think that is extremely powerful to illustrate the challenge in this space, that while of course the Indian government playing a very leading role in this space, we still need a very strong, let's say, evidence and proof of concept before deploying those very sensitive and powerful, government solutions, instruments, and tools. And that illustrates the data challenge, because to a government, we need to really make a very clear, strong case of what is that economic and social value of risk. Just the realization that in a given year, as we are experiencing, a certain event has happened when it happened again 3 years ago, unfortunately may not be sufficient to make a case for that deployment over a period of time. And similarly happens also with the private sector, as in for deploying certain instrument solutions, there needs to be that articulation of what is the case. And I think that is where, while we are making huge progress, we still have some way to go, mainly on analytics and the interpretation from a materiality standpoint, whatever materiality means for either a government or an investor. But we need to make further efforts to facilitate decision-making processes like yourself, rather than maybe expecting or demanding. So I think it's a strong case for collaboration and support in that regard. And then, of course, you touch on financial incentives. And in that regard, let me interpret, and I will allow you to correct me if that was not the direction. But it's true that we need to see how there is a certain correlation between national systemic exposure and, let's put it simplistically, sovereign ratings, and to what extent that kind of default risk at the sovereign level reflects in one degree or the other the future exposure to this risk. And that is actually something that, again, with the support of CDRI, we want to develop in Jamaica and in many other jurisdictions, both OECD and non-OECD. And that is to say, can we provide with a metric that let's say, interrogates how current and future macro indicators integrate physical climate risk into those calculations, and associated to that, then let's drive what are those incentives. So, Pankaj, can I validate with you? Please feel free to correct and add anything to that statement.
Right. So I was less, I think I was speaking a little less about sovereign risk and sovereign ratings. And I think I was more focused really on individual projects because in a large country, typically everything is not government driven. And there's a lot of individual initiative happening, which is as it ought to be. So I think it's more, so the point therefore is, see, we have, as it is, if our starting point is going to be that the past is not a good guide to the future, then we cannot build up a case by saying, oh, this happened 3 years ago, it could happen again. So I think the argument itself has to change. I think the whole narrative has to change.
Yeah, absolutely. Thank you for the clarification, Pankaj. Needless to say, strongly agree. It is interesting how in certain locations where we've been speaking, it was already a few years ago, but the notion of 1 in 100 event occurring the year prior was interpreted as, okay, we are going to be fine 99 years now. So it's all good, when in reality, as we all know here, that is just a probability of a given point in time. But thank you very much, Pankaj, and thank you so much, all panelists, for a really, really rich first round of questions and sharing insights with us and the audience. And if I may just measure the interest by the length and the number of questions that we are receiving, I think that we are being quite successful. So all credit to you, panelists. Before we go into sharing with you some of these questions, I just wanted to start, and I think it's going to be rather brief, but I'm more of like an organic discussion between us. And I wanted to trigger by asking you, Pankaj, you have heard the different perspectives from private, public, and different regions, different approaches, and different views. What are your thoughts? To what extent this discussion adds to the thinking that you had prior to this session today? And maybe in that journey in aligning and bringing together private and public capital. I mean, what else that apart from what you already shared, what is that you needing to advance this discussion even further? Pankaj, over to you. Thank you.
So I think one thing which is particularly interesting, which emerged, is that worrying about disaster resilience or thinking about impact of disasters is not something which is limited to governments or the sovereign. I think the markets are probably much ahead of us in terms of factoring this because they see the impact even faster. And therefore, the kind of things which, say, Macquarie is mentioning, or the kind of things which Australia Super is saying, in a sense, add heft to the arguments which government may want to make. To say that, look, we are not talking about this because it's a quote unquote good thing to do. We are talking about this because it's making commercial sense from all directions. We're talking business. Let's talk commerce. So that is, I think, for me, that's a great takeaway.
Thank you, Pankaj, and of course, incredibly valuable. And it's a challenge because, of course, the social, economic, social and ecosystem considerations are critical too. But it's important to start this discussion from that more risk perspective, and then, of course, we need to add those as potential risks that will be raised. But that is very valuable. And if I may, given the specific reference to Macquarie, Abhishek, can I offer you to then reflect on that, but also add any additional thoughts that this discussion is triggering in what we need for that further alignment or contribution of private capital to public efforts. Over to you. Thank you.
Yeah. So I think, Carlos, there are different roles to be played by different parties in this entire ecosystem, right? Government has an important role to play, which was laid out in terms of laying out some fundamental rules of the game, both commercial as well as socio-economic perspective, right? Because at the end of the day, especially when we're talking about resilience or disaster in infrastructure, it will have a social impact as much as it will have a commercial impact, right? That's absolutely important. The second aspect is, as investors, to be very honest, I'm laser focused on my asset, and I do understand that resilience is not, and the impact is not just because of what I've done in the asset, but a lot around the community. If there are flash floods that happens in my asset, it's not happening because of things I could do better, but there may be some upstream or downstream aspects, right? So the government also can play a role in terms of ensuring that the ecosystem around and the infrastructure around is strengthened, or there's a certain capital that goes in. The second aspect I think I would also encourage is there are different kinds of capital as well. There's a highly concessional capital which has been put together. Actually, go ahead and invest in some of these kind of aspects which are not necessarily right up front commercially viable. So the right use of that concessional capital and putting it in the right manner is also important. And many of that concessional capital can provide first losses, etc. On top of which, commercial capital like us can also come into the picture. I think those are the two things that I would say are extremely important, apart from obviously private sector looking into it from their plans.
Thank you so much, Abhishek. So we are a little bit pressed with time, but maybe we need to go to Q&A. But before that, I really would like to offer any of the other panelists to share any thoughts in the same direction, how this discussion has triggered any additional thinking, questions, or framing of the very topic. So if you could maybe let me know, and I will give you the floor. Don't feel pressed with time, although we are a little bit. But panelists, please let me know if anyone would like to come in. Okay. I think, is that Kelly that wanted to come in?
Yes, yes,
Please.
just really quickly. Thank you, Carlos. I would like to support what Mr. Pankaj said. I think specifically around strengthening policies and standards. You know, Carlos, you mentioned it earlier. We have an asset that we're invested in, and in the term sheet it says it's resilient to 1 in 100-year flooding. However, we had 3 1 in 100-year floods in a decade. So I would encourage an improvement or strengthening in certain standards and policies around climate adaptation and resilience. Thank you.
Thank you. Thank you. And another thing that Pankaj mentioned, that is maybe the notion of force majeure, and that the definition and what is contained within force majeure is less and less unpredictable and foreseeable event. So maybe just to add on complement that. But thank you very much. I believe that was it Michael that wanted to come in? Or,
yeah. Thank you. Yeah,
Michael.
Just a quick comment. I found the discussion very, very interesting, and Abhishek's focus on sort of what I call maintenance capex as sort of critical. I would say, although with our work we try not to say what sustainable infrastructure is. We say there's 15 criteria that need to be considered, and that developers and owners should look at those criteria and work on them. We do also, the group came up with 8 asset types that they generically regarded to be sustainable infrastructure. And I should say that natural capital is one of those 8. And I just wanted to mention natural capital because, on a localized level, it can play a role in building resiliency. And depending on which part of the world you are, there may be natural capital in situ at the beginning that needs to be taken into account and play a key role probably in resiliency going forwards, and also on a writ large as well. Thank you.
Michael, so valuable, and thank you for bringing the theme of natural capital, nature-based solution, because absolutely true. That is the next frontier in resilience, in articulating and actually, sorry to keep coming back to CCRI, but one of the case studies that we're analyzing at the cash flow level is a traditional infrastructure asset where there is a neighboring nature-based solution. And what we're doing is, from a cash flow perspective, attributing CapEx, OpEx, and revenue performance to the existence of that nature-based solution. So we believe that is a way to start before we do standalone, but that is where we need and we will go. But thank you, Michael, for bringing that to the conversation. Rachel, I have to bring you in before we go to the next round of Q&A, and I think that maybe the nature-based solution is also quite a topic that aligns with you. But don't feel that you need to comment on that. Anything else that this discussion has been helpful for you.
No, I absolutely, nature-based solutions. That was a good point. No, I was just going to make the point. I mean, I think this discussion is highlighting just how difficult it is to get the balance right between the regulatory, the subsidy, and the risk forecasting and the insurance. And there are those kind of four blocks, aren't there? It does seem to me that what is super important is that as the private sector kind of learns to model and insure itself, that needs to become a public good in terms of those risk and forecasting models that then are available as well to the public sector. And there's, I think listening to this conversation has just reinforced that for me, that there's something there, isn't there? And I think we have to be very careful with the use of concessional finance, because it's such a very scarce and precious resource, if we think that actual insurance coverage is a better way to manage return. But it's a very difficult judgment. So congratulations on exposing all this and on your work. But I can see some really tough choices for policymakers are coming through loudly.
That is actually a great way to finish, highlighting that there are challenges, highlighting that there is progress, and bringing light to those specific challenges and let's call it the very natural tensions in articulation of what is needed and what is demanded. I think that on concessional finance, it is absolutely true. And I believe that what will be the case for that concessional finance mobilization will be either for vulnerable communities where the risk-adjusted return will never be attractive because of the endemic considerations in a given jurisdiction or asset class, or for the advance of a proof of concept. So the advancement of a proof of concept on a very time-limited basis, so that we advance the proof of concept that the resilient investments are not more expensive investments, are more reliable sources of future cash flows, and that is something that the paradigm needs to change, because we are still thinking that these are more costly investments, so less attractive investment, and that is not the case just because of the imperfect incentives that we have in place, which in turn they suffer from analytics. So it's nobody's fault, but certainly we need to keep pushing, as you rightfully so bring light to, Rachel. This is great. So with that, let's then move to questions, and we have very good ones. So I'm gonna share with you panelists the first one, and if you could just raise your hand physically and let me know who would prefer to take it, that would be very, very helpful. So question one: considering that direct losses due to disasters could be more than 20 times that of other losses, will it help in developing robust models to estimate indirect effects for business and economy? In turn, will this help build stronger business case for investing in disaster resilient infrastructure? While I ask panelists to who would volunteer to start an answer, I will reread it myself. But anyway, who would like to have a first go? So in that case, let me start having a little bit of a framing, and I will go to a couple of you. So the question really focuses on the direct losses due to disasters, and with indirect losses, and that is maybe a term that we need to not clarify, but just agree what we will mean in terms of the answering. What we normally mean in terms of indirect losses is more of the network effect. So in a supply chain or an infrastructure network, how an impact on another section of that network will impact us without us suffering a direct climate hit, let's call it. So in that regard, what the question, I believe, is towards is to frame that those can be more than 20 times that of direct losses. I have my questions. I hadn't seen this magnitude of discrepancy between direct and indirect losses. But let's frame the question as of what is the role of indirect losses when you have that investment assessment? So what, apart from that direct exposure, how do you frame other considerations? Ellie, can I go to you? And you know, recognizing that we would really welcome the person in the audience whom we thank for sharing the question to frame it, but we are not going to have the opportunity. So Kelly, based on what you heard and read, please, if you can share any thoughts in that regard. Thank you.
Yeah, so I can actually, we've had an experience of something what I think the question is asking. We've had an experience where one of our assets was made resilient, one of our older assets and working over time. This asset is resilient. But when there was a climate incident, whilst that asset was made resilient, the employees actually couldn't get into that asset. Not only that, none of the customers or clients could actually get into that asset, which then also resulted in a financial hit at that time. So we have learned that lesson. So what we do now is like a stakeholder management plan where we look at the employees, the community, and what we'd like to do is look more and more at the biodiversity or natural capital. So this is, yes, there are many losses, but this is how we are trying to overcome this. And again, it's something that it's a work in progress, but having a look at the greater stakeholders for that specific infrastructure and seeing how they are resilient to the physical impacts of climate change.
Thank
Hope
you.
that helps answer some of the questions.
A lot. And I think that it helped me understand the question itself. So thank you very much, Kelly. Then we're going to have only the opportunity to share one more question. And if I may, I'm going to pose it to Michael. So what has been the global experience in implementing market-based means of financing infrastructure, bonds, etc.? What could be implications and earnings for the developing countries with limited access to debt and finances? Michael, free to ask for further framing, but over to you for initial thoughts.
Yeah, thank you. Well, it's a great question. I mean, without wanting to generalize too much, I mean, traditionally infrastructure is often financed in a loan market and then possibly refinanced in the bond market. Actually, where I work in asset management within HSBC. There's a lot of work in the private placement market, actually, in the US and LATAM space. So it's not just loans or bonds, it's sort of in the middle private placements. Yeah, I guess in terms of developing world access to funds, it tends to be in the loan market. There's always been, even in the developed market, a hope that a lot of these loan deals would transmogrify into bonds, and everyone in the bond market has been waiting for infrastructure to become a bond market product for the last 15 years. It hasn't really happened. It happens occasionally for some large deals. It happens sporadically. So you still have both the loan and the bond market involved in the developed market. In the developing, it's a combination of solutions. It can be blended finance. It can be a deal with a guarantee from an MDB or from a host government. I suppose often the issue is the size and the need to borrow and the ability to access. And it depends very much, obviously, on the host credit rating. So what I'd say there is Fast Infra, away from the label, which I've talked about largely, has sort of tried to push other initiatives to de-risk projects and to look to how to accelerate flows from the private sector. But they do tend to differ depending on whether you're in a sort of a Chile, or a Colombia with a quite good rating, or you're in a country in Africa with a lower domestic rating. So the solutions offered are different. We have been looking at Fast Infra at power purchase agreements. So, for example, utilities in Africa are prepared to sign PPAs, but the credit quality of the utility is so low, I'm afraid, that it's not really a bankable piece of paper. So can we extend a guarantee to allow that to offset the risk of non-payment for 9 to 12 months against the PPA? So Fast Infra is exploring how we might intervene on a sort of project level to help facilitate in the power sector the renewables. But yeah, it's sort of specific project by project work, I think, often, depending on where you are in the developing world. Maybe other panelists have thoughts on that. Interesting question.
Thank you, Michael, for sharing your thoughts. Very, very valuable, needless to say. Rachel, would you like to complement?
Thank you, Carlos. I guess I keep coming back to this issue really about from the development perspective, which is how can we help that sort of continuum that Michael just described. You know, what is it that is most useful for us to be investing in and doing? And I guess my personal experience has been focusing on the kind of evolution of risk modeling for drought linked to the disaster risk pools. And I think there's something about how are we sufficiently investing in that evolution, I guess, of risk modeling as a public good that can then be available, or to what extent are we expecting the private sector to be absorbing all that cost on a project by project, deal by deal basis. And I do worry, listening even to Michael, that it feels like, you know, we're sort of loading a lot of each transaction with a lot of cost. And I think of the lessons that we've had from disaster risk pools for drought across Africa, where yes, we've had to have a model for every crop, whether it be for sorghum or for maize or for hybrid maize or for, you know, sorghum in the Sahel versus sorghum in North Africa, whatever, that we've had to develop these very sophisticated models, but equally those become kind of public goods. And I suppose for me, that's the question that really keeps jumping back, which is how are we pooling this understanding of risk that can help inform? And I think the points that were made about workers not being able to get into a factory after a risk event, you know, it's about learning and holistic understanding. So yeah, I don't know if that really answers your question, but I think it's the point that I keep coming back to. And I think there is some really interesting work I've seen work in the Philippines and Indonesia with public asset insurance that the international community has been leading, where there's just really interesting sort of very live modeling of flood risk that's beginning to play through into public asset coverage. Yeah, so I think, Carlos, I think those are my key reflections. That how can the whole ecosystem bring this cost down? I think we're all clear that fundamentally taking account of risk and pricing in risk will have positive social impact and positive economic impact. And we just have to be able to work out a way to get the cost balance right, that we're not under-investing in resilient infrastructure that meets the poorest. And that's our kind of collective ambition.
Rachel, again, thanks for bringing us back to that remaining challenge. And I think that what we can conclude and agree is that we have different instruments and that we need to find the right balance of all of them. And that all of this needs to be underpinned to transparent, public good risk modeling. At least a baseline of it. Of course, there can be propositions on top of that are more private commercial, but unless we don't have that agreed upon baseline that is a risk modeling that is public and that is transparent, we don't have this kind of common language upon which to all address and allocate our solutions. I think that the challenges remain, but again, back to the notion of incentives, on how these incentives can really guide what is the right balance of risk transfer. So, you know, risk transfer versus CapEx, so to say. It is the discussion and the different risk allocation considerations. So maybe, unfortunately, not something that we can solve today, but we need to all agree. And Rachel, we thank you for really highlighting that is a remaining question on what is the balance of each of us contributing to this. We ran out of time, and I can see Kamal is giving me very friendly but clear looks that we need to move. Kamal, let me first thank the panelists for a truly great conversation. Really sincere thanks. We take a lot of thoughts, and I hope it was helpful to all of you. To the audience, thank you very much again for sharing your thoughts and questions. We really appreciate those. Apologies we couldn't cover all the questions. And first and last and most importantly, Kamal, CDRI, thank you for the incredible opportunity to be in this fantastic platform. Over to you. Thank you.
Thank you very much, Carlos. That was a scintillating session. We've got a lot of content.
You're on mute, Kamal. Sorry.
Thank you very much, Carlos. That was a scintillating session. We had really variety of perspectives, and I personally learned a lot. Some major takeaways, the whole emphasis on the fact that we have a lack of appropriate investment models for resilient infrastructure, the notion of promoting sustainable infrastructure as an asset class, the whole thing, you early on in the conversation, you reminded that we have to also be aware of risk of pricing risk. We don't want pricing risk to have any sorts of perverse incentives. Mr. Jan's reminder that it's not just enough to have, national level awareness for resilient infrastructure. Ultimately, we have to come up with solutions that work at the project level. He also highlighted that, we have to recognize that it's not just a problem of the government or the sovereigns. It's also of the private sector. It's also for the market to deal with. The whole notion of how do we begin to value the nature-based solutions as well, and not just leave them on the side from our financial calculations and workings. The whole notion of how do we make right use of concessional capitals. And some of the discussion that was happening towards the end of the panel was quite inspiring as well. The emphasis on making risk information, risk modeling techniques, risk modeling products as a public good, as opposed to leaving it just for the private sector to work on. I think that's one of the things that CCRI and CDRI are collaborating on. The CDRI's flagship report will be an outcome of a modeling exercise at the global level, and one of the key products will be a publicly available risk platform. And the final reminder, I think it's an excellent example that Kelly gave, which basically underlines the notion of systemic risk, that you can design a great asset which is very resilient, but it doesn't sit in isolation. There are connections all over, and we really have to talk about the context as well, and we have to pursue resilience more systematically as well beyond our assets too. And that's the endeavor of CDRI and CCRI and our partners. With that, we conclude this session. Thank you very much, Carlos, for the partnership, for working with us in putting this together over the last month and a half. We've had intense engagement with yourself and all the colleagues, and this is just the beginning. I think we'll have more of it in the coming months and years. With that, we'll take a short break, do mic tests, etc. for the next session, and we'll come back to the next session, a very important session on recovery and reconstruction of infrastructure systems after disasters. Thank you very much.